Welcome back. You're watching Power Lunch. Markets about 0.3% higher, still very much in focus. Clarity from the government on the Mauritius tax issue. We'll continue to track that. But let's get impressions from the corporate sector on what the budget did or did not do. Mr. Sivaraman of L&T Finance Holdings is with us for his thoughts. So very good afternoon to you. Thank you so much for coming in indeed. Let me first ask you for a broad impression, sir. We've been getting lots of views. What was your own thought on whether this did anything to revive the overall sentiment in the economy, sir?
Yeah, I think rather than describing this budget as good, bad, the key piece that we need to understand is that what was the, say, as the finance minister himself called as the economic space was very limited, very clearly. So I think that's a piece which all of us have to appreciate. And yes, given the circumstances, the fact that there have been no large tax effort by raise of tax rates or duty rates, etc., is something which we need to appreciate. The most important piece in my view is also that the communication to international investors, the rating agencies, and also to the domestic investors here, that the complete emphasis and focus around managing the fiscal situation in a manner that the credit worthiness of this country can be continuously maintained. I think this is going to change the way the international investors as well as the rating agencies will look at us. It's a big comfort in my view, definitely.
All right, the rating agencies haven't changed their view yet, sir, but I guess they're saying they'll wait and see how it's implemented. But fair point. Sir, I want to talk to you about, the investment side. I mean, everybody in industry, but also in the finance sector is waiting for the investment cycle to pick up in some way. Not sure what people were expecting, but this morning a lot of people are saying they're disappointed that not much has been done other than that investment allowance, sir.
Yeah, let's see it in two perspectives. One is what does budget provide as governments intend to invest on encouraging investment from the private sector. That's one piece. Yes, definitely, other than the investment allowance, we have not seen much really in the budget. But I think we need to appreciate that there is a constraint that he has got in working around with the budget numbers. But the more important piece in my view is that while the rating agencies would wait for actual realization of the budget goals, be it the fiscal deficit target for the current year or the next year, all right. I think the most important piece will be the encouragement to capital flows into the country. That will happen as a result of the budget statements on fiscal deficit and the commitment towards maintaining the fiscal discipline in the country. I think the capital flows will change the way we look at it, because it's going to have a cascading effect in terms of the exchange rate, consequently the oil prices and what it does to inflation and the virtuous cycle that it can potentially set up. I would like to see this as a very clear positive view going forward in my view, and that's going to be the most important piece in getting investment back onto the table.
The other, so macro aspect then is, whether enough room has been created for, looser monetary policy, and that was linked into the fiscal side as well. Your impression there, sir? Does the central bank get a bit more comfort in terms of reducing rates?
Well, one can speculate about whether the 4.8% next year fiscal deficit goal will be achieved or not. We can continue to speculate, but I would say that yes, at least the commitment is there, and I think it was very loudly seen even at the cost of squeezing out some of the liquidity out of our monetary system, but the government's commitment to maintain the fiscal deficit was very clearly seen. So I would guess that even 4.8% will be an important goal for the government to achieve, right? And they would do everything to make it achieve. But let's look at it in a practical sense, that whether the revenue goals will be met by the government. What I've seen is that, there is about 3 to 4% of additional tax effort in the form of raising some of the direct tax rates and changing some of the other duty structures. That's one piece. The second piece is that, yes, it assumes about somewhere between 6 to 6.7% as the growth rate for the next year, which is on a real basis. So the third piece will be maybe add about 5 to 7% of inflation, right, which would potentially contribute to the revenue growth as well. So all in all, I don't see that to be completely out of target. Maybe he will still fall short of 1 to 2%. One other way to look at it, that perhaps if there was enough of consumption impetus which was put in place, maybe the revenue goals would have been far easily achieved than what it looks today.
So two specific issues, one was on IDFs. I mean, the finance minister talked about it, but he didn't announce anything new, right? I mean, it's the same structure. He just mentioned that IDFs will be encouraged and the Asian Development Bank would play a larger role together with IFCL, but was there anything new in it, sir?
No, nothing new other than the bringing about parity in the distribution tax for between NBFCs as well as the mutual funds. That's what he did in terms of what he brought about it. Yes, there is. I think they have done what they need to do in terms of structurally and regulatorily facilitating an IDF to be in place, and it is for the entities now to really take off from here, and with good participation from owners of projects as well as the owners of the loans currently, that it will end up really receiving the impetus. The incentive, the framework for encouraging international cash flows into this initiative is already in place, right? Now it's a function of how the credit views taken by the international investors and how we translate into really making it grow on the ground.
Just one last word, sir, on the the 50,000 crore tax-free bond. The number there. Any impressions? Is that a good number? Is the market in a position to absorb? Is there demand for these tax-free bonds, sir, out there?
Yeah. See, there are going to be competing instruments in the market in the form of, say, FMPs and investment in mutual funds, and how one sees the rate, the yield curve moving in the future, right? To some extent, that has actually impacted the way responses have been to current year tax-free bonds. It's not been one of the best. It has not been as what I would say enthusiastic as it was seen last year. To some extent, the limitation on how much individuals can invest in these bonds. Almost the corporates have really not invested in this as in the last occasion. All of them have had an impact, but I would say that it's a balance between how much tax collection one wants to achieve versus how much you want to provide money in a subsidized manner to the infrastructure segment. But I would say that in the context of the way the yield curve is expected to move in the near future, I'm sure that for the infrastructure segment itself, it may not be such a major game changer in my view.
All right, so great hearing from you. Hope to see you more often on the show. Thanks for your impressions on the big picture on the budget and some of those specific issues. Mr. N. Sivaraman of L&T Finance Holdings. Slipping into a very quick break, back with a quick market check and we'll wrap it up.